when you look at an insurance company's balance sheet, there are a few metrics that you definitely need to look at to understand what's going on, and they're different than other companies' metrics, right? Because like there's some things that you look at for any company that you're going to research, but for insurance companies, you need to look at the loss ratio, the expense ratio, and the combined ratio.
Right. So let's break those down. So the loss ratio is the percentage of premiums earned that are paid out in losses. So if I get in a car accident today and do $1,000 of damage to my car, that would show up in the loss ratio because that's actual money paid out for losses. Then you have expenses, which are things like advertising or getting a claims adjuster to show up to look at my car. And that would go in the expenses. And then when you add those together, you get the combined ratio, which is the percentage of money paid out in claims and expenses to run the insurance company as a percentage of premiums.
As a percentage of premium. So like it's the loss ratio plus the expense ratio over premium. So would you want a higher or a lower combined ratio? Because this tripped me up the first time that I tried to analyze an insurance company.
Right, you definitely want a lower combined ratio. A lower combined ratio would mean that you have a fatter underwriting margin, meaning you're making more money on each dollar of premium that comes in.
Right. And this is actually, I think, a really interesting topic. I don't know if everyone thinks this is interesting, but actuarial tables are fascinating because they have these lists of risk factors, and they can just, run their fingers across the lines and figure out exactly how risky you are for any given thing. So companies that are better at underwriting are going to have better combined ratios. So this is how you check if a company is doing well on that side of their business, right? Just like the actual business of insurance.
Right, exactly. So the key to running a great insurance company is pricing risk correctly. It's very easy to grow premiums. It's very easy to grow revenue. All you have to do is write bad risk, right? All you have to do is insure something that should cost $100 for $50. But ultimately, at the end of the day, there's nothing wrong with being small and being very profitable at the premiums you do right, or the policies you do right.
Again, just like banks with loans, except in this case, it's insurance.